Hello, welcome to The Dividend Way. In this video, we aim to explain clearly what a dividend is. So, what is a dividend? A dividend is a payment made by a company to their shareholders, usually from their profits, if their business is performing well anyway. The board of directors determine how much the company is going to be paying out. Obviously, if it's been a good year for the company profit-wise, then they shouldn't have a problem paying the dividend. They may even raise the amount from previous years. This is called dividend growth. So if you buy a share in a dividend-paying company, then you may receive a payment into your account. The time that you buy the share matters. There are cut-off dates as to when you can qualify for the dividend payment for each company. This is called the ex-dividend date. You must have purchased the stock before this date in order to get the dividend payment. The payment can take around 4 to 6 weeks to arrive. This varies from company to company. Most companies split the dividend payments, so you may receive multiple payments throughout the year. A lot of US stocks pay out 4 times a year, whereas stocks from the UK tend to be twice a year. However, it can vary depending on the company's preference. Now, not all companies pay dividends. This could be down to them deciding that they could reinvest the money into other areas of their business. These are called growth companies. A few examples of growth companies are Tesla, Amazon, and Netflix. These companies currently don't pay a dividend. There are some well-established companies that have been paying dividends consistently for a long period of time. These are deemed as reliable dividend payers. A few examples of these companies are Johnson & Johnson, Procter & Gamble, and 3M. So, how does a company benefit from paying a dividend? Firstly, it encourages shareholders to hold on to their shares to receive the payment. It stabilises the share price as it attracts long-term investors. Generally, companies that have paid dividends consistently for a long period of time are seen as stable, reliable companies. A dividend can be seen as a positive sign, showing the company's confidence of future earnings. How do dividends benefit us as the shareholder? Dividends can provide a great passive stream of income for the shareholder without having to sell your shares in the company. A good dividend-paying company increases the amount they pay you each year per share that you own. For example, one year they may pay you £5 in dividend payments, and the following year pay you £5.50. This is without you buying any more shares. Reinvesting dividends would mean you can increase your shares in a company. This in turn will create a snowball effect, which will compound over time. If you invest for the long term into good dividend-paying stocks, you could build yourself a great passive income to pay your bills and support your lifestyle, and possibly retire from active work. The great thing about dividend-paying companies is that they are generally less volatile than non-dividend-paying companies. This means that their share price doesn't fluctuate as much. Using a dividend investing strategy is not a get-rich-quick scheme. You have to have a long-term outlook to allow the compounding effect to take place. It's not all plain sailing. You have to be careful which dividend companies you invest in, as dividend payments can be cut, meaning you won't get any payment from that company. That's why it's paramount to do your research before investing into any stock to know whether their dividend is safe or at risk of being cut. In some circumstances, a company cutting its dividend is the smart thing to do for their future, as they can re-establish the dividend later on. And that brings us to the end of this video. If you have any questions, feel free to comment below. Otherwise, we hope that you found this video helpful. Please like, share and subscribe.